mean, everything in life seems to turn out for the better, so I don't have any complaints about that, but it was a dumb thing to do. You really want to be in a wonderful business, because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money.
Did you know that 90% of day traders lose money? The stock market feels like a complicated maze designed to take your hard-earned cash. You watch others building wealth while your savings sit idle, losing value to inflation every day. The financial world seems designed for insiders with fancy degrees and complicated algorithms. But what if I told you that Warren Buffett, one of the world's richest investors, follows just 3 straightforward rules that anyone can use? Today, I'm breaking down the Oracle of Omaha's time-tested strategy that turned $10,000 into over $90 billion. No complex formulas, no financial jargon, just 3 simple principles that have created more wealth than almost any other investment approach in history. Before we dive into Warren Buffett's 3 rules, let's quickly understand who we're learning from. Born in 1930 in Omaha, Nebraska, Buffett bought his first stock at just 11 years old. Today, he's the chairman and CEO of Berkshire Hathaway, a conglomerate holding company that owns dozens of businesses including Geico, Duracell, and Dairy Queen. What makes Buffett remarkable isn't just his wealth, it's his consistency. Through market crashes, recessions, and technological revolutions, his fundamental approach hasn't changed. While Wall Street embraces complexity, Buffett embraces simplicity. As he famously said, "The business schools reward complex behavior more than simple behavior, but simple behavior is more effective." That simplicity is at the heart of his success. And today we're focusing on the 3 rules that form the backbone of his investment philosophy. Buffett's first rule is deceptively simple: never lose money. His second rule? Never forget rule number 1. This might sound obvious, of course you don't want to lose money. But there's profound wisdom here that most investors miss. When Buffett says never lose money, he's not suggesting that you'll never experience temporary downturns. What he means is that you should focus on capital preservation above all else. Why? Because mathematics is cruel when it comes to losses. If your investment drops 50%, you don't need a 50% gain to break even. You need a 100% gain. Let that sink in. A 50% loss requires a 100% gain just to get back to where you started. This is why Buffett is extremely cautious about his investments. He's famous for his margin of safety concept, never buying a business unless its intrinsic value is significantly higher than its market price. So how do you apply this in practical terms? Avoid speculation. Don't chase hot tips or invest in businesses you don't understand. Think long-term. Short-term trading dramatically increases your risk of permanent capital loss. Do your research. Before investing in any company, understand its business model, competitive advantages, and financial health. Be patient. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Remember, the goal isn't to get rich quick. It's to get rich slowly but surely, without devastating setbacks along the way. Buffett's second rule is equally simple but profoundly important. Only invest in businesses you understand. This approach, which Buffett calls staying within your circle of competence, has saved him from countless losses over the decades. During the dot-com bubble of the late 1990s, Buffett famously avoided tech stocks. While everyone criticized him for missing the tech boom, he stood firm, saying he didn't understand how these businesses would make sustainable profits. When the bubble burst in 2000, Buffett's portfolio remained intact while others lost fortunes. Your circle of competence is simply what you know well. Maybe you work in healthcare and understand pharmaceutical companies. Perhaps you're a software developer who understands certain tech businesses. Or maybe you're a dedicated consumer of certain products and understand those industries. The key is honesty with yourself about what you truly understand versus what you merely think you understand. Here's how to apply this rule. Make a list of industries and business models you genuinely understand. Focus your research on companies within these industries. Expand your circle gradually through deliberate learning, not impulsive investing. Be comfortable saying, "I don't know." Not knowing is better than falsely believing you know. As Buffett's partner Charlie Munger says, knowing what you don't know is more useful than being brilliant. This doesn't mean you can never invest in sectors outside your expertise. Index funds that track the entire market can be an excellent solution, which brings us to Buffett's third rule. Buffett's third rule represents a significant evolution in his thinking. Early in his career, influenced by his mentor Benjamin Graham, Buffett focused on buying mediocre businesses at bargain prices. But under the influence of Charlie Munger, he shifted to buying wonderful businesses at fair prices. But what makes a business wonderful? Durable competitive advantages, also called economic moats. These are features that protect a company from competition. Think of Coca-Cola's brand power or Apple's ecosystem. Consistent earnings. The business should have a history of stable, predictable profits. High return on equity. The company efficiently turns shareholder investments into profits. Low debt. The business isn't over-leveraged with excessive borrowing. Simple, understandable business model. The company's path to profitability is clear and straightforward. When Buffett finds these characteristics, he's willing to pay a fair price, not necessarily a bargain price. As he famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." For beginning investors, this often means focusing on established companies with strong brands, loyal customers, and consistent profits rather than speculative growth stocks that might be the next big thing. And what if you don't feel confident identifying these wonderful businesses yourself? Buffett has clear advice for average investors. Low-cost index funds that track the S&P 500 or the total stock market. By doing this, you're essentially buying small pieces of hundreds of businesses, many of which have the characteristics Buffett values. Let's bring these three rules together into a practical approach for beginning investors. Never lose money. Focus on preservation of capital first, gain second. Invest in what you understand. Stay within your circle of competence. Buy wonderful businesses at fair prices, quality over bargains. For most beginners, Buffett recommends a simple approach. Start with index funds. Low-cost S&P 500 or total market index funds give you broad exposure to the market's growth. Invest regularly. Set up automatic monthly investments regardless of market conditions. Be patient. The market rewards long-term thinking. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Gradually build knowledge. As you gain confidence, you might allocate a small portion of your portfolio to individual companies that you thoroughly understand. Remember that Buffett built his fortune over decades, not overnight. The magic of his approach is in the simplicity and consistency. The real power comes from combining these principles with time. Through the miracle of compounding, modest but consistent investments can grow into substantial wealth over decades. Investment doesn't have to be complicated. Warren Buffett, one of history's greatest investors, has shown that simple principles, consistently applied over long periods, can generate extraordinary results. To recap, never lose money. Protect your capital at all costs. Invest in what you understand. Stay within your circle of competence. Buy wonderful businesses at fair prices, quality over bargains. Whether you're just starting with a few $100s or managing a larger portfolio, these principles remain equally powerful. The beauty of Buffett's approach is that it doesn't require complex strategies, advanced degrees, or expensive tools, just patience, discipline, and common sense. Remember, the goal isn't to get rich quickly, it's to get rich surely. By following these time-tested rules, you're not just investing like Buffett, you're thinking like Buffett. If you found this helpful, please hit the like button and subscribe for more straightforward financial wisdom. Drop a comment below sharing which of these 3 rules resonated most with you. Thanks for watching, and here's to your financial success.